Hello all, today we're going to discuss about substantive and control test of the investment cycle and cash balance transaction. First, let me introduce our comrade. First Andrezal, then me, myself Raditya Bayu Aji, and Fani Rais. Let's start this from audit objective first. In audit objective, there is existence and occurrence, completeness, right and obligation, assessment or allocation, and last but not least, presentation and completeness. Next, there is audit planning consideration. First, at materiality. Securities held as short-term investment can be material to an entity's short-term solvency, but return on such securities are rarely significant to the entity's results of operation outside the financial service sector. Second, inherent risk. The inherent risk is the investment cycle assertion is influenced by many factors, and the volume of investment transaction is generally quite low. Analytical procedure risk. The analytical procedure can compare the current year balance with the previous years, or it can compare the actual result on the investment amount and the investment return with budgeted or the other documentation of the management plan. Thus, we had control risk, an understanding of several factors of the control environment and is relevant for audit of the transaction cycle. Substantive testing of investment. It means it is common practice to perform substantive tests of the investment cycle to test investment balance on the balance sheet and income statement of the same time.
Next presentation is the sec R. 1. Determine the detection risk. In applying an audit risk model to determine detection risk for the investment cycle assertion, the auditor needs to combine his assessment of inherent risk and control over cash, receipts, and payment transaction with additional consideration unique to investment transaction is to designing substantive test. The balance breakdown test category contains the greatest possible number of tests and that various tests can facilitate attaining the lowest acceptable level of detection risk that might be required for valuation, assertion, or allocation and presentation and disclosure. Next, designing substantive test. Each of these tests is described in the following section. A. Initial procedure. Auditor gets an understanding of the client's business and industry. The match between the initial investment balance and the amount audited in the previous year's working paper is verified. B. Analytical procedures includes the relationship between specific accounts during the current period and their comparison with previous year's data, budget amounts, and other expectations. C. Testing transaction details. This substantive test consists of vouching for S from the debit and credit paragraph in various investment account. D. Balance detail testing. Checks and calculate the securities at hand, confirming securities held by other parties, and calculate the resulting investment income. Next is the interest earned and the interest collect and on investment in bonds can be verified by examining the securities and payment that's shown on the bond certificate. A. Testing of balance details, accounting estimates. When auditing investment, The auditor shall apply a significant audit judgment with respect to evaluating the number one, the appropriate clarification of investment, and two, the fair value of the investment. B. Comparison of report presentation with GEEP. Previous substantive test should provide the amount of evidence the auditor needs to determine whether investment balance have been identified and properly clarified in the financial statement. Next, cash balance. Cash balance include unpaid and hand received cash in the bank, in general and saving account, as well as impression accounts such as petty cash and bank account for salaries. The relationship between cash balance and the transaction cycle. The five transaction cycle are directly related to general cash balance. The five cycle are the cycle of income, expenditure, financing, investment, and personal service. service. The production cycle has no transaction that are directly related to cash.
Audit objective consists of assessing category and purpose of the audit balance account. Assessing category number one, existence or occurrence. Cash balance are recorded and the balance sheet date. Number two, compliance. The record balance include the effect of all transactions that have occurred here, and cash transfer between banks have been recorded in the current period. Number three, right and obligation. The, the entity has legal rights over all cash balance that are shown on the balance sheet date. Number four, assessment or allocation. The record cash balance have been released and the amounts set on the balance sheet and in accordance with the supporting schedule. Number five, presentation and disclosure. Cash balance have been identification and classification appropriate on the balance sheet. Audit planning consideration. Number one, materiality. When it is like two transactions in five transaction cycles, the that ever cash, the amount of cash flowing toward the accounts in on time period can actually be material additive. Number two, inherent risks. A high volume of transaction can create a significant level of inherent risk for certain cash balance assertion, particularly existence and occurrence and complaints. Number three, the risk of analysis procedure. Effective analysis procedure include comparing cash balance with forecasts or budgets, or with company policies regarding minimum cash balance and investing in excess cash. Number four, control risk. Because of the susceptibility of cash balance to theft, many auditors will careful evaluate internal control over cash and ensure that any report condition are clearly communicated to management. Next, the exam substantive test. Number one, initial procedure. Gain an understanding of the client's current business and therefore determine the significance of cash balance and transaction for the entity. Number two, analytical procedure. Perform the analytical procedure by developing the cash balance to the budget amount, previous year balance, or the expected amount and calculating cash a balance take of current assets and comparing it with expectation. Number three, testing transaction details. Carry out the cash cut of those. This the note may have been performed as part of an audit program for accounts receivable and accounts payable. Number four, balance detail testing. Calculating the cash in hand that has not been deposited and determining that amount has been recorded in the cash balance. Confirms the loss balance from the bank and confirms other arrangement with the bank. Number five, comparing report presentation with GAAP. Determine whether cash balance have been identified and clarification are appropriately determine determine the bank overdrafts have been reclassified as current liability. Conduct Q&A with management, review correspondence with banks and review board of directors meeting minutes to determine matters requiring disclosure such as credit line, collaterals, loans, balance compensation, agreement or other restriction on cash balance. Next, other consideration. Number one, test for detecting lapping. Lapping is a deviation caused by deliberate misappropriation of cash receipts. Number two, audit lapping procedure. A. Confirm accounts receivable. B. Perform sudden cash calculation.
Alright then, thank you for your attention and goodbye. Have a nice day.